So hello and welcome to our webinar, Plan for a Rich Future. Making your money work harder for you is one of the smartest things you can do. And growing your money is easier than you may think. It doesn't matter how much you have, it's what you do with it that counts. With some effort and planning, you can make your money work for you so that you can live the life you want. Today's webinar is the fourth in our series of the Women's Series webinars. But don't fear, we have had 3 other webinars, but they are available on our website if you have missed them. We did have webinars on financial goal setting, rebuilding after divorce, and supercharge your super. So if you missed any of these, please check out our website, smartbusinesssolutions.com.au, select the Learning Centre and select videos and webinars. So with the feedback that we've received from these webinars, we actually have added 2 more webinars to this series, insurance stripped bare and estate planning. So today's webinar will run for approximately 1 hour, and we will of course have time for questions at the end of the session today. So if you can please pop your questions in the Q&A box at the bottom of your screen, and we can either pop those in while you're thinking of them during the webinar or towards the end of the session, and we will go through those for you today. So to cover off the fine print, this presentation contains general advice and does not take into account your personal situation, but we are more than happy for you to contact us and we can arrange a chat if you'd like some personal advice. It is nice to put a face to a name. So we'd like to introduce you to some of our wonderful team, which some of you may already have met. And for the new faces joining our webinar today, these are some of the faces behind the names of our team that you can work with you to achieve your goals through financial planning and mortgage broking. We are super fortunate to have an in-house mortgage broker, Carly Davin. Carly is an accountant by qualification, then financial advisor, and then mortgage broker. So Carly was a financial advisor for over 10 years and then moved across to mortgage broking. And with all this knowledge, working with Carly enables us to provide our clients with valuable strategies. So unfortunately, due to timing, Carly could not join us today. But when we are talking about finance and lending, it's not just getting that loan across the line, it's all about strategy. So what we really want to talk about today are the strategies, getting a home loan or investment loan. And to introduce you to today's main presenter, today is Shannon Smith. Shannon is the founder and managing director of Smart Business Solutions Group. Shannon is an award-winning and innovative qualified accountant, financial advisor, and certified mortgage broker. Busy lady. Shannon's most recent awards are the Australian Accounting Awards Regional Firm of the Year winner, Financial Advisor of the Year, and Goals-Based Advisor of the Year. So Shannon is an expert in goals-based financial advice, self-managed super funds, retirement planning, and Shannon even advises other financial advisors. Pretty special. My name is Bianca Carroll. I'm your secondary presenter for today's session. I've completed my Masters in Financial Planning. I've completed my FASIA exam in my professional year, working towards my goal of becoming a qualified financial advisor like Shannon. So let's talk agenda. There are lots of different ways to invest your money, and the best method depends on your goals and circumstances. Learn about this and more strategies on investing money, debt management, and planning for a richer future. So the key areas that we'll cover today are leveraging your existing assets to grow your assets, choosing the right home loan, offset accounts, investment loans, renovation loans, refinancing your existing home loan, commercial and business loans. So let's get super excited and introduce your main presenter for today. Welcome to Shannon.
Great. Thanks very much, Bianca. And Bianca, in her description about herself, missed one little fine print that happened last week. As she said, she has completed her Masters. Last week, she actually received a notification that she had the highest. Now, if anyone needs assistance with your parents for aged care, Bianca topped the whole of the country in 2021 with the highest result in the Masters level subject of aged care, which she got notified last week, which is a great achievement. So what I want to really talk about today, it's not about the basics of a home loan, what is a home loan, and there may be many of you that have those, but how can you be looking at your home loan not as just the loan that I have on my house where I'm living, or even on an investment property? How can you look at that more strategically, and how does that fit in with your overall situation, overall personal and maybe business situation and wealth creation, and looking at from a retirement perspective? So in pulling together this presentation, I guess it's something that I was trying to even search and see what else was out there available in this area, and I really couldn't find much. But there's so many times that when I'm going through advice with clients, I find there's so many powerful things. And I think working with Carly, having been a financial advisor for so long and a mortgage broker, really being able to pick up what are some of those strategies that we're not thinking about when people are just getting a home loan. So really trying to have a look at some of those kind of little bits of, I guess, nuggets of information that we can give you, so that you can probably start to look at your lending situation a lot differently, and see what opportunities that you can get. So to start that off, and one of my kind of key focus areas when I'm talking with clients on growing wealth is around leveraging your assets to grow assets. Now, I'm sure and many of you probably, like my parents said, the good thing that you need to do in life is you need to pay off your home. Now, when you own your own home in Australia, life is good. That should be your number one focus when you're going through. And that was something that, was one of my early time. Okay, just got to pay off the home loan, pay off the home loan. Now, there is merit to that somewhat, but what about the situation that you spend the next, whether it be 10 years or so, maybe longer, paying off of that home loan, and you come to me after that and you say, great, I've paid off my home loan, now I'm ready to start saving some other money so I can really build up some wealth. Now, one thing that's really interesting around leverage is those that really do successfully attain wealth, and you've probably seen friends or family, there'll be friends and family of yours that you look at and you say, they don't just have one investment property in their home, they tend to have multiple investment properties, and and maybe the holiday home as well. And part of that really comes down to this looking at leverage. So leverage is really, I call it kind of literally an investment strategy of using your money, obviously being comfortable with that, and seeing what else can you do instead of just going on that mindset of paying off the house and then then looking, because you've missed out on potentially the 10 years of growth. Now, what would be the difference if instead of paying off that home in 10 years, if you actually invested in another asset and actually had two assets growing over that 10-year period? Where would you be financially in 10 years' time if you had two assets growing? You probably still would have a debt owing at that point in 10 years. Maybe would it take you 15 years to get that debt paid off? So where would that be? So really looking at leverage and looking at debt in a different way, that debt is not always just a bad thing. There can be what I call good debt. And often with your home, we often look at that as being debt that is not tax deductible. And therefore, let's try and get that down to a minimum. But where is there an opportunity that you may actually use some of the leverage that you have in your, say, family home to actually put you in a better financial position overall, and start using that leverage and that equity that you've maybe built up for other investments, whether they be property or maybe other investments that you're really looking at. So to try and start looking differently at how to leverage your assets that you've got now, really to create additional wealth, because the leverage is actually going to help you, I guess, kind of achieve more growth. And it's going to be an interesting market over this next period, over the next 12 months, to see what happens in the property market. There's a lot of people out there with opinions. I know I've got my own opinions, and I'm kind of probably getting a bit sick of the TV's opinions on things and the media that we keep getting. But it will be an interesting market, because I think what's happened in COVID did go against what a lot of us would have expected from an economics perspective. But looking at leveraging your assets for overall wealth creation and helping you get further is, what do you currently have available? So what is it that you've got, whether it be cash savings or other investments or your home? What is your risk profile? Now, the reason I highlight that is that, when you are leveraging, you need to be in a sense, comfortable with the fact that, there is that, coming away from that security blanket of maybe having your house paid off in X number of years to investing in another asset. And that's something I like to work with clients to say, well, here's the scenario. If you paid off your house in 10 years' time, here's where you would be in 15 years. Whereas if we actually use some leverage on that property to do other investments, here's where where you would be financially. So really trying to get that appetite on what is your risk in having that leverage, because obviously the leverage means more debt, and what's your comfort level, because we do want to always make sure people can sleep comfortably at night when you've got that kind of level. What is your short and long-term goals? So what are those goals that you're looking at on what would it be that if the short-term goal might be to pay off the home, or the short-term goal might be to get that investment, how can we look at, do we need to move some of those goals, or what might be that the end goal? We work with a lot of clients when you're looking at even potentially the property in super, especially depending on their age. If we've got a long time up our sleeve until they're going to be at retirement, there's some really good opportunities to look at doing that from a self-managed super. Could also be, even if I look now, I have a number of clients that buy a property now as an investment, negative gearing, and that leverage part of it, using the house, knowing that, okay, in 10 to 15 years' time, we may be in a position where, one of them is paid off, or we may want to use that property ourselves as a holiday home. And so I frequently see that. So if that was a long-term goal that we want, and I've got, one client at the moment, they want to retire and have, when they retire in about 15 years, they want to have a house in Queensland and a house here in down on the peninsula. And so getting that investment property in Queensland that's now actually using the leverage in the house, knowing they won't have their home loan paid off within the next few years. Instead, it's going to be a longer period because we've used some leverage there. We've got debt on the Queensland property, but having a strategy and a plan to get to a position where what can we achieve in 15 years so that they could have that goal of having, the house 6 months of the year in Queensland and the house 6 months of the year here. So really having a think about what are your short and long-term goals so that you can try and use this equity that you've built up to your benefit on that, and having a look at your investment strategy on what you're looking and your focus is on that. And that's really important to make sure that, is it property or is it other investments? Stock markets had a lot of interesting movements over the last 12 months, even over the last month. But, if it is looking at property, is it a buy and hold situation? Are you looking at renovating, or are you looking for long-term capital growth? So really trying to be clear about that so that we then can have a look at, and when you go into your actual financing part of it, it is a different viewpoint or a different way in which we're going through when we know some of that. So when I say choosing the right home loan, not going to go through, in a sense, I say all the basics on it. I'm looking at it from a full strategic perspective on how it fits into your own personal and business situation. So, looking at finding the property, an affordable property, not necessarily always the cheapest loan. A lot of people focus just on the interest rate with the cheapest loan. Really, and if I jump even on one of my other points, is looking at the loan features that you might have. And then also, like, what's the total upfront costing of the purchasing of the property and also of the loan that you're looking at getting. So when I like to look at those, I want to look at, if it's an investment property that you're going into, you need to look at the full life cycle of that and what are the full costs, not just getting, what's the cheapest loan at that point, because as we know at the moment, the loan rates are going to keep changing. Fixed rates are nearly at the point where it's not attractive to even go into it because obviously the banks are nervous around that side. I say learning to budget and save. I know you're looking at, whether it be the home or the investment property, but making sure that you've actually got that pattern that you can say, if, especially if you've got these investments and you've leveraged, and this comes down to that comfort, making sure that you're actually comfortable that you do have those funds should something, a rental be vacant, or what are those budgeted funds that you're putting aside at the moment as well. One thing when I'm looking at the overall strategy and looking at the loan is often I will have a client who say, I'm going to buy an investment property. How much should I borrow versus the equity that I put into it? And there are some ways which I find quite exciting. Maybe people not in tax wouldn't, but there are opportunities if I'm looking at it overall to say, well, what about we look at getting 100% debt on your investment, on the investment that you're looking at? Because this is leverage. A client said, I've got, this, I want to buy this investment. I want to have, 2 assets. And people often say to me, well, how do I do that? Because I thought I had to have 20% deposit, otherwise I pay that, that extra insurance. This can be where we can actually leverage the home and maybe use some of the equity that you have in your home as the security for the other 20%, so that we can get a loan that is actually 100% for the investment property. Why would that be good? Because that means 100% you get interest deduction on 100% of the, in a sense, the loan but dash value of that property, rather than just having rather than having to put 20% dollars into the investment property up front, of which most likely you've taken it out of your home loan offset account or from that perspective. So there are opportunities that you may actually be able to get into the market at a certain time that you don't have those dollars saved up, but maybe it's a case of being able to refinance the home and grab some of that equity to enable us to get 100% loan on an investment property, which is great from a tax outcome, getting yourself in the market at a particular time that maybe you would have thought, okay, I'm going to take another year or two if I go back to my learn to budget and save a year or two before I get that deposit. Well, maybe we can get it today by getting that equity out of the home and being able to do it. And making sure that whenever you're looking at finance, is looking the strategic advice and how it fits around, in a sense, I say your whole financial picture. So it's not just quick, get the loan for that particular amount, making sure that how does that fit in with your overall situation, like what I just explained about the opportunity with the home as well. So I very much like to have a look at it as a holistic perspective on it. On offset accounts, I'm sure there's many of you that may have offset accounts on your loans at the moment. Offset accounts, it does work a lot like a savings account, and it does give you this opportunity if you're wanting to make sure that you can minimise, in a sense, your interest costs during that year when you have the additional, maybe putting your earnings in there each month and really trying to make a big difference on that side. And it potentially allows you to pay your loan down sooner. But the other opportunity is it may be also for strategic investment where you're saving up those additional funds. So having that offset account, you may not be aware, I think a lot of people overlook this, but having an offset account actually does do a little bit of a difference to your interest rate often. It's only a slight difference, but it does make your interest rate a little bit more expensive, but often the benefits that give you on that flexibility. And the other part when I'm looking at this strategically also is if a client has a few loans, I may look at whether often brokers will say to them, oh, we'll get an offset account for you, which, with every single loan that they've got. That may not be, if you're looking at an overall, that may not be a great strategic outcome because you're paying an extra interest rate on every single one of your loans. Now, if you have investment loans, and investment loans and a home loan, well, maybe we just look at getting an offset account against your home loan because that's the non-deductible interest that you're paying. So we want every spare bit of money going into there. And maybe we don't need an offset account against any of these investment properties because until the home loan is paid off, we don't want to pay the extra interest that we have to pay because we have an offset account attached. Now, it's only a small percentage, but, every little bit counts. So there's some of those types of things that I do find brokers often go, well, we'll just add an offset account to every single loan that you've got without explaining the detail that does come at an extra cost. You are paying for that privilege as well. Now, just to highlight that you can take advantage of a tax deduction. Now, the reason I say that is that if you do have an investment property and you have an offset account on it, and let's just say you came into some money or you sold another property or something and you had some of this spare cash and you think, oh, I'm just going to put it against that loan. Well, whatever you do, don't put it in the redraw. It needs to go into the offset account because for tax purposes, for us to be still able to claim the interest when you decide to take that money back out, we can only do that if you've put it into an offset account. So there can, it is important to do that. Again, that comes part, and I had a client actually just last week that didn't think about that, put the money into the loan, into the redraw, and wants to take it out again, and it resets actually the loan amount that we can claim as a deduction. So really important when you're looking at any of these little financial aspects to kind of just flag it, with your accountant and financial advisor, say, I'm looking at doing this. Should I be doing this in a different way, or is there any other way to be structuring it? So there can be some really good benefits just on making sure. And these are only minor tweaks, but sometimes it can make a big difference as well. You know, on investment loans, and I've touched on some of this as well, but, you know, security and investment rate will be different on investment loans. So that's where we might look at, well, how can we, you have the investment loan, what can we do with your home loan? Is there any way that we can use some of that or the security, cross security as well, that will actually maybe put us in a better position on the investment side? And also looking at that deposit, what can we use maybe potentially with, you know, maybe your home, or how can we structure that on an investment loan? And just as Eva even touched on before, is just looking at that offset and the redraw facility with an investment loan. Again, as I said, that maybe you may not get an offset account with your investment loan because you've got your home loan, and at the time you pay off potentially in years to come your home loan, then we might refinance the investment loans to get an offset account, because now it's important at that. So it is important when you're looking at an investment loan, you are going to have a higher interest rate with the investment loan, because the banks very much gone are the days, and this whole responsible lending, when all those poor people will manage to get money that they faked all the documents, and the bank lent the money and then they said it was the bank's fault. So all of that responsible lending that came in at that time, it changed the rules around when you would have, many of you may have had where in the past you wanted to draw down some extra money from your home loan to maybe do a renovation, and the banks actually didn't ask any questions. As long as you had equity in your home, you could service it. It was no problem. What you'll find now is the banks all ask, what are you doing with it? Why? What's the serviceability? And all of those other questions. So that's where, I guess, from an investment perspective, looking at it overall as to where we can have, some of those opportunities on the investment, especially even with some investments. I mean, we've just done one now, Carly and I, where we've looked at, we're refinancing the home loan to pull down some additional funds because they are doing renovations, trying to get a bit more because they do want to look at putting an investment property later. So we're kind of, I guess we've worked out basically a 2-year plan with them on how we're going to do with the lending. And I think if you speak to many people, they don't have someone who's actually advising them other than just the transaction of getting a home loan on making sure that you're getting that advice. I do have a lot of people that ask me about renovation loans. So I want to get a loan for my renovation. Actually, there is actually no technical loan out there called a renovation loan. There are a lot of people just use the equity where possible in their house to be able to get that. It may be for a renovation, but it's not a renovation loan. The only one that it might be sometimes people have a construction loan, but a construction loan is completely different to a renovation loan where you are actually going through there. So that can be potentially looking at how much equity you've got in your property and being able to draw down from that perspective on the renovation. What I'm seeing the banks doing now also is asking for quotes on the renovation. If it's anything more than 50,000, they're often asking for quotes to show that you're going to draw down that, request that money, draw it down, and then actually use it for that. So you might be needing to get some quotes from that perspective as well. The other big thing I like to say to people is, well, again, this comes back to your plan. What is your plan with your home? Is it your forever home? I know myself, I'm probably, spending lots of money on doing all these renovations because I am never moving. I don't want to clean up, pack up, or anything like that. I'm not moving, so all of that's going to be returned to me at some point, the value. But if you're planning on moving in 3 years or 5 years, this isn't your forever home, make sure you have a look at that, you're about to kind of invest this extra funds in, what is it that you're investing, and is that going to be, what the market wants around you, and what is going on there. It's interesting on the renovation. I was reading some articles recently that the houses now at the moment selling, and I think we all know that, with the shows like The Block and things like that, everyone was a renovation expert. And apparently the houses that are all fully renovated, given the costs of renovation and everything at the moment, are actually a lot more appealing. So it's an interesting time that we're going into, with the costings of all of that going up as well. So just to look at refinance, we've actually had quite a lot of questions on refinance with clients. What do I do with the interest rates going up? Do I refinance? Am I going to get a better interest rate? Now, when the rates were going down, refinancing, it was a scramble. Everyone was refinancing because the rates, were, there were so many different options available from that side. Refinancing, potentially there'll be a few triggers for that. It could be for a lower interest rate. Now, there is, I guess the rates are going up. That's always going to be a possibility. What I'm actually seeing now that a lot of the banks are nervous around it, they are trying to compete a little bit on interest rates, but they're also, the way the banking system works, they also need to have a certain amount of cover from their side on how much they've got on lending and residential. So I think they're being a lot more conservative in the way in which they're approaching things, especially because there is an expectation, would the property market drop? If the property market dropped, what impact would that have on the bank? So you might be looking to refinance for a new for a lower interest rate. You may get that at the moment, but it may not be it may not be a significant amount. So, and that's why when I look to refinance, you want to actually make sure that you're actually looking at the overall cost on it. But it could be also a loan with more suitable terms and features. As I mentioned, a lot of my clients, when I'm looking at investment properties and they've got a home loan, I won't be looking at always having the offset account in the investment property. Now, if they've got their home loan, maybe paid off or something like that, I might be like, well, look, you might want to refinance so we can get an offset account so that you can start, also saving on that rather than just having the money sitting in the bank as well. And it just could be some other features. So often that'll be around the strategy side of it, and again, reducing your mortgage repayment. Could be most often or more often than not, at the moment, is more to get more cash out, which either could be whether we're looking at another investment property, so doing that leverage part, or whether we're actually looking at on the renovation side of things as well, or debt consolidation. You may have a few different debts that we want to consolidate through. I know over time some clients have had a loan and then they've got another loan to do, part of something else, and it's come through as a construction loan, and then there's another loan. So we might look to consolidate or switch lenders for whatever reason, or reduce fees. So there can be a number of different ways. What I am actually seeing in the last few weeks is, whilst the banks acknowledge that interest rate shopping is going to be harder, they are giving attractive lump sums, so like $2,500 if you refinance with us, or $4,000 if you refinance. So there are a few lump sums, and even when you get that, I like to always say, I'm sitting with Carly, is we need to go through, well, how much exercise is it going to be for you to go through that process? What are you going to save? So it's not just about the interest rate you're going to save or that cash back that you're going to save. Are there any costs in you doing that? Are there any other features that we can get out of the change as well? So there can be some really good opportunities. It's not just about, a lot of people think refinance is just about the interest rate, or even potentially getting some extra cash out. And the cash out bit can be really really useful from a planning perspective when we're looking at the overall financial situation as well. And I just wanted to bring this back as well, and I see that a number of you on today's also are business owners as well, is a lot of people have their business loans and debts, or maybe they deal with the bank and they've got they might be building up cash in their business as well, and then they've got their home loan and other personal aspects. It's really important to understand the interlink between the business and between the personal situation. I have a number of clients that say to me, I've got cash in the business, should I just pay for that new car? Should I just pay for that new piece of equipment? Saves me going through getting an equipment finance or a car loan in the business for that. And my number one rule on that is, whilst you still have a personal home loan, or basically any personal debt that is not tax deductible, then always be getting finance for the business, so that the business has tax deductible debt on that. And if you had, let's just say you had $50,000 in your bank in the business that you had built up, you had more than a buffer in the business, and you were looking to buy a $50,000 car, and you say, well, actually, I've got the money in the business, maybe I'll just use the money in the business to buy that car. I would rather you take that $50,000 out of the business. Now, of course, we have to deal with the tax aspects of that. That's fine. Take that money out of the business, put that into your home loan, or your offset on your home loan, reduce your non-deductible debt that you have the business paying tax deductible interest rather than having it on the other side. So it is good to look at the business and as a wider strategy, because I do see a lot of times the number of clients that have bought assets outright. It may be a $20,000 asset. Equipment finance, it's so quick and easy to get equipment finance. You can get approval within 24 hours. They don't really even look at much of the, brief look at the financials. So, but having the ability of that extra cash coming and reducing non-deductible debt, or potentially, having it outside of your business and having available to do further leverage in buying other investments is really important. So just to highlight that there is an interlink between your personal situation and your business, and why looking at your loans and your lending as a kind of overall, I think is really important. And it can actually be useful to improve on your business. And I highlight this because number of times I've seen clients that have, kind of hesitated in wanting to invest in that next piece of equipment. Oh, I just want to maybe build up a bit more funds and all of that. And I guess when I've chatted through and said, well, if you had this new piece of equipment, what would that enable you to do? And it is an evaluation. You don't just need to, I know a lot of people want to buy equipment and things like that at the moment because it's a great tax outcome at the moment. But if you don't need the equipment and it's not going to add value to your bottom line, then don't buy it. But there can be benefit of getting, say, whether it be equipment finance, where you can have the asset now. Yes, we've got the tax benefit. So that gets the tax benefit now 100% write-off. You've actually done equipment finance, so you're paying it off over, say, 5 years. The interest rates are still really competitive on the equipment finance. Gone are the days, I remember 10 plus years ago, the interest rates were double digits and, equipment finance was horrible at that point, but it's really, quite competitive. But if you are able to generate more sales, more business, you've got that benefit. But at the moment, and until June next year, you get 100% write-off for tax purposes. You're paying it off over 5 years. So you're getting a cash flow benefit. Now you're getting a cash flow benefit of tax saved. And then if that cash does build up, what else can we do with it? What can we do in getting that out and getting it onto your home loan as well? So do always have a consider, yes, you've got your business and the business finances and what you're looking at, but consider that as part of your overall, what are we doing as our overall short-term strategy and also our long-term strategy, from building the business, building our wealth, and also the debt management side of things. Where do we, a lot of us want to get to retirement and we want to be debt free by retirement. Okay, what does that mean? Does it mean that we sell an asset at retirement? Does it mean that we've already paid it all off by retirement? Making sure you've got that link together. And I guess touching on, business loan and going a bit off track, but not, is even looking, if I look at SMSFs, because that's actually considered a business loan. But looking at an SMSF, and for those of you who may have been on our other webinars, we can send the links out, or you'll find them on our website, talking about buying property, using your SMSF to buy property. I like to say feeding your property addiction using your super. But looking at opportunities, when I talk about the leverage there, a lot of people in their super, just years ago when you couldn't lend, would buy an asset and it would just be that asset in their super. I now encourage clients to say, if we've got time on our side, I'd rather you borrow what you can up to, often that's 70%, maybe 80% in your super, rather than buying, let's just say one factory for 600,000. Could we use, 300,000, or could we use even a bit less to buy one factory, borrow for that, and let it take its course on paying the loan off with the rent, etc., and use the other funds, whether you want another property or whether you want to invest that in the markets and we can invest it. Then you've got two assets growing. Let's just say you've got 15 years till retirement. You've got two assets growing over 15 years. We may have done a 15-year loan on that asset, and with the intention that would be paid off. So you've got the growth of those. I have some clients over the years that they're onto their third factory or fourth factory, because as they've built up enough extra funds in their super, where they've then used that as a deposit for the next one and for the next one. Will they have all of those paid off by retirement? No, they probably won't be paid off by retirement, but that's okay, because once you get to 60, if you sell the property and it's in your super fund, so it has to be a self-managed super fund, all of that's tax-free. So you could have had those assets for 10 years, 15 years, any capital gain throughout that whole time. Once you're age 60 and in pension phase or in retirement phase, you could sell one asset. So I have a lot of clients that we have the strategy to look at selling one of those properties when they're age 60 and at retirement, to basically crystallize and sell that completely tax-free, take the funds and pay off all the debts. But all this while now, we've been helping to build up, that growth. It could very well be they get to retirement, the debts are not that great, and they say, not that high, so not a big problem. And they may not sell it because all the income that you earn on those properties in your super becomes all tax-free as well. So they might say, well, the loans are being paid by the rent, so we just keep it. So when you're looking at your home loan, you're looking at your business, it's really important to take a step back and look at all of it, not just look at that one, home loan as one complete separate situation, because there are so many opportunities, going back to that leverage, obviously going to the point of being comfortable with that leverage, and knowing that my home loan is not paid off in 5 years, it's going to be 10 years, but being able to look at, well, what can we do with growth, on growth assets to be able to help you, more strategically manage that side as well. So some of the, just summarizing, I guess, some of my key takeaway messages on looking at, the financing side of it is consider lending as part of your wider financial position. I think a lot of people look at it as a standalone transaction. Know and monitor your equity, and if that equity is building up and that's something that you're more comfortable with, is there an opportunity for you to try and help build your wealth through that, rather than just looking at how I can keep saving this money to get a deposit for the next, the next investment. I do actually say it's not a set and forget. It is your money. I think over time, people are getting more focused and understanding more about their lending side of things, their value of the properties, and also their value of super. And I think it's really important on one of those, because ultimately those two assets do become, for a lot of people, your biggest assets as well. And business and personal really needs a strategy on it, so that I know a lot of times, with equipment, someone's like, oh, the car's just come in, I'm just going to do it, it's next week, I have to pay it. But I think it does pay to have a look and have an overall strategy on that side. So how a financial advisor can help, this is where we can come in and help put it into perspective and try and actually have that overall goal and weaving that in as well, so that there is a plan. What does 10 years look like? What does 15 years look like? So that maybe it does give you that comfort level if you do go down the path of looking at leverage, of knowing, well, what does that mean in that period of time? What am I going to retire on? What's that dollar figure that I'm going to retire on? If I do nothing, what am I going to retire on? And what's the disconnect between those two as well? So I'll open it up to questions and see if we've got any questions that have come through, Bianca, at all, or if you have questions, if you just want to put that in the questions down there as well.
Yep. So we've just got one at the moment. What is the difference between the offset and the redraw?
Yep. So that offset and redraw, it's a really, a lot of people do get confused with that. So with the redraw, that is actually, you've got a home loan or any loan. So, but you've got your, let's say, home loan. You've got a home loan account. It may have a redraw facility. So it is basically just one account. It's your home loan. If you ask the bank, they look at it and say, well, it's one account. The redraw is just a facility. That means they will track, when you put in extra money, they will track it to be able to say, look, we know you've actually prepaid $20,000. So if you want that $20,000 back out, we'll let you take it out because you're ahead of your payments. And so that's what a redraw facility is. It allows you to then redraw it. But it is, when you put it in, it reduces your interest. Interest that you're going to have payable. It reduces your loan balance as well from that perspective. The difference with an offset, and the offset is more important when it comes to investment properties. And the reason for that is that if you have an investment property, actually I can give you a good client's example. So I had a client with an investment property. So just to go back, sorry, on an offset account, it is a completely separate bank account. You have two accounts. You have a home loan account, you have an offset account. The bank when they calculate your interest, they net the two, and then they calculate the interest. So you're getting the same impact as an offset account and redraw. You're getting the same financial impact, but the difference comes into when you've got an investment property. And I'll use a client example. A client had an investment property. Let's say round figures, they had $500,000 in their a $500,000 loan. They had $300,000 that they still had a $500,000 loan, sorry, and they on the property with whatever it was worth, and they had an offset account, a few dollars in the offset account, not much. They sold their family home, and they decided that they would live in their investment property while they were building their new home. So they sold the family home, and they have a lot of extra funds. They put those funds into an offset account, and their home loan or their investment loan for that investment property basically had $500,000 loan. They had $500,000 they put into the offset account. So whilst they were living there, in a sense, for personal purposes, they actually had no mortgage in a sense. They did have it. They had no interest deduction, and the payments literally just went from one account to the other, rounded like this. So you still had payments, you just had no interest from that perspective. When they finished building their personal home, they moved into their personal home, they pulled all the money out of the offset, and they started renting that property out. From an ATO perspective, that loan was the $500,000. And we were able to still claim now, going forward, the interest on the $500,000. If they had mistakenly, like client last Friday, got that money and put it into the redraw account, the ATO says, well, that loan is all combined. You've paid off that loan. You don't have a loan on that property. So when they moved the money back out and then started to rent it, the loan would be deemed to be zero. So you lose your actual tax. So it's really important from an investment property perspective, not so much on the personal level, but from an investment property perspective, it's really, really important.
Makes a big difference.
Yeah.
So just to review, also, Shannon, just on the investment property, using your home equity and loaning 100%.
Yep.
Can we just review that one again, please?
Okay. Yep. Okay. So on the what the opportunity is with that is if you're investing, you've got an investment property. We want to get, because that's tax deductible debt, we want to get the highest amount of debt. Now, if I use an example, if you had combined, let's say round figures, combined $1 million of debt between your home loan and your investment property. So combined is $1 million of debt. I want to get between the two of them the maximum amount of tax deductible debt rather than having it non-deductible on the house. So when you look at borrowing, for an investment property, let's just say the investment property was $1 million. So you're saying, okay, well, I'm going to borrow 80% because I don't want to pay that mortgage insurance that you have to pay if you don't have at least 20% deposit. So you have a loan of $800,000. Now, if we can use the security of your house because you've built up the equity, we could actually go, and it would be with the same bank, and actually borrow 100% of the value of the property with none of that mortgage insurance, which is the bit that we're all trying to avoid with the 20%, because we've used security from your house. So we get a tax deduction on the interest payable on $1 million of the debt, whereas if you actually used money from your offset account on your home loan and you drew it down and you said, oh, well, I've saved up this money in my offset account, I'm going to use that, and use that actually as the deposit, the $200,000. So I only borrowed the 80%, so that $800,000, you would only get a deduction on the $800,000 worth of loan repayments interest, and that $200,000, well, you've taken it off your home loan and you've invested it, but it's actually not, it's still linked in a sense to your home loan. So you're paying non-deductible interest on that $200,000 and you've got deductible on the 100. So it's about looking at if we can use some of the equity that you've got and security of your home to get 100%. And it's not about going and just buying a property at 100% in a sense debt. It's about strategically being able to claim 100% interest on 100% of the property, rather than just what a lot of people do is pull that down, use that as a deposit, and then borrow and get only 80%. So that's just an opportunity when we're looking at if there's an opportunity to refinance and be able to use that security, that really helps on that side.
Great, thank you.
Yeah.
If anyone else has any more questions, if they could pop them in the Q&A box there for us.
Yep. Or send us a note. Yeah, so as I said, the upcoming series that we want to go through, insurance stripped bare. So it's not going to be, we don't want to make these boring things. That's why I didn't go through. This is a home loan. This is what are these key value things that you can really think about on it. And insurance is one of those necessary evils. I like to call it a Band-Aid of when you really need that potential, you need it. Your goal is to strive towards being self-insured. Your goal is to get to a position where you don't need the insurance company, and therefore you don't need the premiums to be paid, and be self-insured. But unfortunately, if you've got young kids, if you've got a home loan, you do need that in place just to help you should something go. And I guess I've seen on a number of occasions with clients where we've had to make claims that whilst we all don't like paying for insurance, the benefit that it's given our clients in times which have been pretty, crappy, and being able to have that financial side, has been really beneficial. And then the other one is peace of mind with the end in mind, and looking at some strategic around estate planning and asset protection on the estate planning. How do you keep your hard-earned money that gets passed down to your kids in your bloodline and not end up with, maybe you don't like one of the kids' partners and then they end up getting divorced and money goes off. So there are some strategies to look at around that. And also situations if something was to happen to you and, your partner inherits everything because money's gone from one to the other and they repartner, what happens to your kids? With the inheritance. So I can speak from, some of my friends' experience where that has happened, where, the father has repartnered and since then passed away and had a family friend that actually ended up with nothing out of that situation. So that's really sparked my interest in estate planning and making sure I spent so much time with clients, helping them grow, helping them get this, and it's kind of that last bit of the link in making sure it stays in the bloodline and protecting them as well. We've got all of this, so today's video and also some others. If you go onto our YouTube, you'll see a lot of the different sessions that we've got recorded there. I'm sure it's better than Netflix. We should see how it's rating. I know one of our videos is over 35,000 views. So my son was in my YouTube account trying to work out how he could get me paid for that. But I know it was interesting that we had Xero was one of the advertisements on that. So we must be getting some traction on some of the videos. But yeah, if there's any other topics you'd like us to cover, let us know. Because I really enjoy these sessions and really enjoy actually helping women to kind of get more financially savvy if they haven't always been at the forefront of, in those decision-making process as well. Feel free to reach out to either myself or Bianca, and especially if your parents need aged care, you now know who literally the country expert on aged care is with Bianca. So thanks very much for joining, and we'll put this video up as well.
Thank you.
Thanks a lot.